If you own shares in a company that is outside of Australia, then today's video is for you because I'm going to be answering the question of how does foreign shares get taxed in Australia. Hello everyone, I am Ethan Rushock, and on today's video I'm going to be talking to you about how foreign tax works on shares in Australia. So what I mean by this is I'm going to be talking about investments that you make in overseas companies or overseas property, for instance, and how that gets taxed in the Australian tax system. So what I'm talking about here is companies that are based overseas. So for instance, we've got Facebook in America, or you've got something like Alibaba out of China. So these are different investments you're making in companies that have their base of operations overseas and are listed on overseas stock exchanges. So pretty much anything that's not listed on the ASX. And so just quickly, the reason people do this is for diversification. So if you think about the Australian Stock Exchange is less than 2% of the global market. So that is such a small percentage of the overall market. So by only investing in Australia, you are missing out on a lot of diversification. So if in Australia we have a downturn in the economy and you're only invested in Australia, you're taking on more risk there. So people diversify to reduce risk. So the biggest area that people invest in at the moment is America, but there's growing markets in China and in other areas of Asia. So there's lots of ways you can diversify, but it's important to understand how you're going to pay tax on this foreign income. The other thing people like about diversification is they can invest in companies that they know of. So there's lots of big American companies, Facebook, Apple, Google, that people know and they use these products every day and therefore they want to be able to invest in them. Alright, just a quick break from this video before I get into how the tax on it works. I just want to thank you for being here. If this is your first time watching, I do lots of videos on tax in Australia as well as investing and personal finance in general. So I'd love for you to hit that like button, and really, it would really mean so much to me if you could hit that subscribe button. Alright, let's get back into the video. Alright, so the way it works overall, it's very similar to Australian income, but obviously you need to make sure everything's converted back into Australian dollars. So again, as I've spoke about in a previous video, which I'll link up here, which is all about tax on shares, which I'll go into this in more details, but there's pretty much two types of income. So you've got dividend income or any other kind of distribution income, and then you've got capital gains income. So we'll start with dividend income quickly, or distribution income. So pretty much what will happen here is you'll receive income, or it might be a dividend reinvestment, but this income needs to be converted back to Australian dollars. So this is pretty simple, that if you get, for instance, $100 US that you've received as a dividend and you convert this to Australian dollars, so I think at the moment the exchange rate is about 75 cents. So we do that and we end up with about 133 Australian dollars. So this $133 is what you would include as income in your tax return. So you include it in your tax return at the Australian dollar value, not in the currency of where the investment's held. Now the other thing you want to do is check whether there's been any foreign tax paid on this. So Australia has tax treaties with over 40 countries and they include a lot of the major ones, and it's a double taxation treaty, so we're trying to avoid paying tax in two separate countries. So the way this works is if you've paid tax in a foreign country, then you can claim that tax as a foreign tax offset. So again, this obviously needs to be converted to Australian dollars, and this is included in your tax return as a foreign tax offset, and works the same way as, say, a franking credit would on a dividend in Australia. It just shows as a credit of tax paid, and therefore when you calculate the taxable payable at the end of the year, that will include is your tax credit. Now obviously the way this works depends on which country the income is coming from, so you're going to have to do some research on that. I'm not going to cover all the different treaties here. So just do a quick search of Australian tax treaty with America, for instance, and you'll find a document about that, and then you can have a look into what the treaty is and how that works. So capital gains is similar again, but it is a little bit more complex because you need to remember to convert at buy date and sell date. So as I've talked about before, you're obviously going to take your sell price plus any brokerage, etc., less your purchase price plus brokerage, and that'll get you your gain. All right, so here is a quick example on how this would work. So say we've got 1,000 shares at $5 US. So the buyer's 5,000 US. And then we go sell them, say 3 months later, so there's no discounts to worry about. And we sell those 1,000 shares for $10 US. So we've got a $10,000 sale price there, a $5,000 purchase. So we've made a $5,000 US gain. Now, so let's assume that when we bought them, that we still have got that 75 cents exchange rate. So that buy is worth $6,667 approximately in Australian dollars. Now let's assume when we go to sell, the dollar's moved. So now 1 Australian dollar is only worth 50 cents US. So now the actual Australian dollar value of that $10,000 sale price is now actually worth $20,000. So now we have to do that calculation of the $20,000 less the $6,667. So we actually have over a $13,000 gain here. The reason for this is we've made a capital gain on the thing, but this has also involved a currency gain within this. So we've now received a much larger gain than what we initially had. And obviously this can go the other way if the exchange rate was to move the other way, that you may actually have made a gain on the price of the shares, but you may have made a loss overall because the currency might have moved in the other direction. So it is something to consider when you're investing overseas, that if currency changes as well, then you're going to have a change in your overall profit and loss. Now you can go down the path of hedging these gains. That is a whole nother story. It might be something I talk about in the future, but there is that option out there. All right, so once you've converted your income back into Australian dollars, you then need to include it in your tax return. So there is a section in the tax return for foreign income. So like I said, you want to include that foreign income in Australian dollars, and then you want to include the foreign tax offset also in Australian dollars. So the other thing to consider when it comes to this is if you do have discounts involved and foreign tax on these, you will need to do a bit more research into this. So as you can see from this article here, there are some talks about where you've got a taxable capital gain, which is eligible for a discount, but then that discount means that your foreign tax offset may be discounted by that same amount as well. So that is just something you need to look into, do your research on it, or get advice on this when you go to do your tax return. So as you can see overall, it doesn't have to be complicated. It's very similar to Australian shares. You've just got to remember to convert everything back to Australian dollars. The same principles go here if you had a overseas property. You're just converting everything back into Australian dollars and including it in the foreign income section of your tax return. So keep your records and make sure you're keeping them in Australian dollars, and you'll have no issues when it comes to foreign tax on investments. If you want to see more of my videos about this, make sure you check out the videos that are about to come up, and I thank you for watching it, and I'll see you soon.